Hello, everybody, and welcome back to the EDPF 50-Day Property Challenge. We are here again with Jared and Matt L, and today we are going to talk about bond finance, and we have Miguel Martins of Absa Bank with us today to walk us through the process. So for today, we are going to listen to Miguel most of the time. There will be some Q&A between ourselves, and hopefully we will help you, the public, to learn all about how to use the bank, not just Absa, but all the banks, to use the bank in order to raise money so that you can purchase your first property within your 50-day challenge. So sit back, relax, and enjoy the segment with us.
So Nigel asked me, so we kind of said how's it to each other, and just quick intro. I'm from Absa Home Loans. I look after the investor portfolio. So all our customers that own multiple properties, I tend to look at their portfolio and see how we can help, how we can evolve our home loan proposition to be more investor friendly, etc. So that's my day job. And then after 6, I'm an investor myself. So in the Joburg area, so I'm my own customer when it comes to that. So I have my own interests at heart, and it's a great way of bringing, I guess, my hobby and my passion, together with my work. I guess you guys know all about that, right? So it doesn't happen too often in corporate, and corporate can be very frustrating, but so we get through it. And Nigel asked me to come on and really talk to you guys about buying your first property and what's involved, and kind of go from A to C. So kind of go from So this is like kind of a bit of a 101 in property finance, and I've got a couple slides that kind of guide the thinking, and sometimes a picture is worth 1,000 words. It's a discussion. Let's have a presentation. So I'm going to switch over to some slides. If it's just the three of us, there's no need to write questions. We can, just stop and ask a question, and let's go from there. Make it a conversation. Would that be okay?
I'm cool with that.
Awesome.
No problem.
Awesome. So let's just find this. So this is I did a session with Nigel's students, I think we call it. Yeah. Okay. Can you see a full screen?
Yes, I can.
Yes.
Okay, brilliant. Okay. So, So really, this was actually a 3-part series that we did for Nigel's mentees. And we're just going to cover like the first part today, and we can see where the conversation goes. But we're going to look at how, obtaining finance as a salaried individuals. I know you with yourselves, you probably sit in the self-employed side, so we'll kind of break out into that as well. But looking at affordability, credit bureau, property valuation, and then how to get a home loan if you are looking at investing. Okay. And we can definitely have that conversation if that's interest to you. But that's right at the end. We'll just probably get through the basics if that's okay. So maybe a comment around affordability. So let me just put my volume up. Okay, so affordability. So at about 2007, 2008, the National Credit Act came into being. And really, what that does effectively, in very simple terms, is it puts the onus on the bank to ensure that the person applying for the loan can sustainably afford the loan payments. So it's no longer the bank. It's not just up to the person providing their own details. The bank also has to verify that the person is actually receiving that income, etc. And if they don't, the bank can be accused of reckless lending, where there's fines involved. They have to let the person off in terms of their loan obligations, etc. So the entire onus is on the bank to ensure that the applicant can afford the loan. There's some very specific structures in the NCA and in the National Credit Act in terms of what that looks like, what the banks must look for. But it's become a lot more stringent than it used to be. And I still get people telling me who got a home loan 10 years, now what's it, 13, 14 years ago, pre-2008. Why is it so difficult to get a home loan? Well, the bank needs to conform with this. When we look at affordability, the types of income that we look at are salaried income, commission, self-employed, rental income. In the case if you're running your company through a PTY, in terms of what the PTY's income looks like. So all the normal kind of requirements in terms of what looks like income. And off that, so then there's a calculation that happens, and basically we take off your, okay, if you're buying your first home, if you're paying rent, we obviously ignore that because you won't be paying that rent going forward. But we take off any car payments, store payments, credit card payments, Vodacom, MTN, Wi-Fi, all those normal payments that groceries, school fees, all those payments that you would need to carry on paying, along with your home loan payment. The only payments that we don't take into account are like savings. So if you're putting in 2,000 Rand aside every month towards a savings account, that you can stop any time. No one's going to force you to keep that payment going. So we ignore those. Those are discretionary. That kind of payment is discretionary. But otherwise, we really want to have a good view as to what your disposable income is, and then that disposable income is what we apply towards the home loan payments. So how much can you afford? What does that look like? So number one, as a rule of thumb, we look at repayment to income. So if you take your average monthly income, we would take 30% of that gross income, so pre-tax. So if you're earning 30,000 a month pre-tax, then 30% of that is roughly, it's about not quite 10, it's about 9,000. And that 9,000 is effectively what you can afford for a home loan payment. Okay, that's a rule of thumb. But like I said, on the right-hand side, essentially it's income less expenses. That tells you what's available from a lending perspective. So if you go onto a lot of the bank sites and originators, mortgage originators, they all have calculators, and you can go and play there and kind of get a sense for what you can afford. I opened up the ABSA website. I thought it'd be great just to kind of go and have a look at what that looks like. And let me see if I can go there. Just because. Are you seeing my screen? Or must I?
Yes,
So I'm going to
I am
stop
seeing your
sharing.
screen. Okay.
Okay. Oops, sorry guys. Let me see if I can. And I literally just want to show you, where are we? What these calculators look like, and just go through one or two calculators, and they're quite useful. Okay. So if you're seeing this is on the ABSA website, right? So I use the example here. If I put in gross monthly income, we put in 30,000. Okay. At what interest rate currently 7.25%. That's the current interest rate over 20 years. You can see that. Sure, I'm not sure why that's showing there, but you can afford a monthly payment of 9,000 Rand. See if I haven't done something incorrect here. 7.25. Okay, there we go. 7.25. You can afford a 1.1 million Rand loan. that'll cost you 9,000 a month. Now, just
Okay.
quickly, what's nice about this is everyone's going to start talking about increasing interest rates. So if you're concerned that interest rates are going to go back to where they were before, and we'll talk a little bit more about that later. So where were they a year and a half ago? They were closer to 10%. And that's 9,000 Rand, which is roughly a third, and 30% of that 30,000 Rand can only afford you 900,000 Rand. So what that means is that at the current low rates, you can afford more than you might in a year or two's time when interest rates have gone back to where they were. But of course, let me show how big it was. So if you can see at 10%, you can afford this. In this example, you can afford 932,000. If we go back to 7.25%, it increases to 1.13. It's about a 200,000 Rand difference. That's a hell of a big difference. Okay. So if we just go into this other calculator here, and let's say today you say, sure, let me go and borrow. Let me go buy 1.1 million Rand home. I'm gonna if it's a bit of luck, I'll get 100% loan, so zero deposit. There we are, just short of, I think it was 1138. I think it was. There we go. Okay, almost close back to our 9,000 Rand a month. Okay, now that's at 7.25. Now this calculation tells you, what will my monthly repayment be if interest and at a certain interest rate. So here your 1138, 1.1 million is going to stay flat still, but it's just your interest rate's going to increase. You're going to see what happens at 10. Is that 9,000 becomes 10,900. It almost increases by 2,000 Rand to just short of 2,000 Rand. So a lot of guys have bought recently, if they haven't accommodated the fact that interest rates will go back to where they were before, and they bought a 1.1 million Rand home, they over the forecast of the next year or two, their monthly payments are going to increase by almost 2,000 Rand. So that increasing rates do really put people under pressure. Cool. Okay. Let me know. Am I back at my slide?
You're still on the calculator.
Okay. So I need to then just stop sharing and then go back to the slides. All right.
Cool.
So it's just there are a couple of calculators, and whether you go to Absa's one or the other banks or one of the mortgage originators, that they are useful. They definitely do give you a sense of what you can afford based on your income, and also allow you to play around a bit just to see what happens if things start increasing. And that's also in the case of joints. So if you earn 30 and your wife earns 30, well then your gross income is 60. So then the numbers change. So you do definitely add up your incomes to see how much you can afford.
Might have to just rope her in for this.
No, it's important, right? These are from a banker perspective, these are kind of like things we talk about a lot and quite easily.
Yeah.
But most people don't necessarily appreciate this. And this is where having like a good home loans consultant when the time comes, just to ask them the questions, because now it's all nice to be in theory. When it becomes very real, and you actually got a house you want to look at with an offer to purchase, you definitely want some very clear direction and advice as to what's the implications of this.
Yeah.
So definitely cool. Okay, credit bureau. So the bank really looks at three things. One is affordability. One is your credit. The second one is your credit score, and the last one is the houses, the property's valuation, and which we'll come to just now. So in terms of your credit score, there are two large credit bureaus that we look at: TransUnion and Experian. One we don't look at, which is the TPN Credit Bureau. I'll tell you about that in a second. And really what TransUnion and Experian and a couple others that, what they do is they pull your payment behavior from the likes of Vodacom, Edgar's, anywhere where you have a contracted loan and you're having to pay someone off. Even nowadays, this is where TPN comes in. TPN is a credit bureau for people paying their rents, as well as parents paying school fees. And so wherever you have a contract commitment to that payment behavior gets uploaded to one of these credit bureaus. And what they do with that is that based on that, they pull a score together. It's called the Delphi score. Various different scores that just say this person pays their debts well, or this person is overdebted. They might be paying well, but they're a little bit more overdebted than they should be. But it really does come down to payment behavior. And the banks will pull information from the likes of TransUnion and Experian, and then the banks will create their own credit profiles. We've got very clever guys with propeller heads in the back, and they really do pull they pull the external information together. Of course, we have clients who are paying us, for personal loans and credit cards, etc. We match that, and we create our own credit scores. And based on this, when you come for a loan, this is the second thing we look at very quickly is what is your credit score? What's been your payment behavior? Now, if you've missed one or two payments, that's not the end of the world. It's just that your credit score drops a bit, so you're categorized as a slightly higher risk, and the bank may require that you put in a bit of a deposit, and your interest rate might go up because of it. So it's not that banks say no, unless that they consider the behavior as such that it's not someone that they would have to take a risk on. So this credit bureau, it's always considered to be something that's like out there, and we don't quite know what's my score, and what can I do about it. So each one of these, legally, you can go to TransUnion, you can pull a report on yourself once a year for free. They will have to give you a report. Them, Experian, TPN, etc. And you just go onto their website, you find the right page, you might have to register. And in doing so, you'll be amazed at how much information is collected about you. And it's really something, it's really interesting exercise to do. And it really does create that awareness that you really got to look after your credit score. If there's one thing maybe walk away with today is protect your credit score. It's extremely valuable. There is a nice app that you can use, and I've got this app. It's called Clear Score. I'm on Android, so I downloaded it off the Play Store. But I think Apple, the iStore will have the same. And this I go to once a month. It updates, and this effectively, I'm not sure which bureau it connects to, but it keeps track of my score. And the reason I do this, other than just generally keeping track, is to make sure actually that no one's stolen my identity and is using my identity to go and get credits out there. So I do keep track of this. As a property investor, my credit score is very important to me. I can't invest, I can't finance without a good credit score. So I do keep track of it. But it's a great way also just to check for identity theft, to be honest. And it's a free app. Anyone can pull. Now here, for example, 681 out of 700. Now this is Clear Score's credit score. ABSA, Standard Bank, FNB, Nedbank, they will have different numbers. So for example, ABSA has a ranking out of 10, 1, 2, 3, 4, 5, 7, 9, 10. Not the 681 out of 700, but it'll broadly come to the same thing. 681, I think, is a very good score. So this will be like a 1 a 1 in our space, which is the best score you can get. And it drops down quite quickly at about 600, 620. You're probably sitting at 6 or 7, maybe 8. So it really just is a nice way of just keeping track of your credit score. And as I said, even identity theft. Then the property valuation. So now we have checked that you can afford it. You can afford the loan that you're requesting, that you have the affordability, so you can afford it, that you have demonstrated that over multiple institutions, you can keep up with your commitments to pay your loans, whether it's your gym, your school fees, or your Standard Bank, or your Standard Bank personal loan. That all comes together. So tick. The last thing is then property valuation. So if you're going for an application for a home loan, they will give you, the banks will usually come back to you pretty quick, within 2 or 3 days, with a grant in principle. And the reason why they're saying principle, because it's subject to a property valuation. They may either send someone out to have a look at the property, or they might do what they call a desktop valuation, where they look at properties in the area. They put a deeds office report, etc. And what they really want to know is that if you want to buy this 1 million rand home, is the property actually worth 1 million? Because at the end of the day, if things don't work out and you aren't able to make your payments, in the worst case scenario, that property is there to settle your loan with the bank. So very critical for the bank to secure their loan, but also even for yourself, that should things not work out, so should there be a problem for whatever reason, you want to be able to say, okay, let me sell my property, and hopefully the price that you get, you'll be able to settle your loan. What the bank will often do with a property value is what they call loan to value. They might say, look, we're only willing to give you 90%, which means you've got to put down a 10% deposit. They won't always necessarily give you a 100% loan, which I think as self-employed individuals yourselves, Jared and Tabaleng, you probably will find yourself in that situation, where the bank will be happy to give you up to 90%. Now, there's a good and a bad there. Yeah, so you got to come up with a 10% deposit. If you're buying a 1 million rand home, you got to now come up with 100,000 rand. That's actually a challenge in itself. But 90% LTV reduces the price. So at 100%, where you might have paid prime plus half, now you might pay prime because you're at 90%, even maybe prime minus 0.1. So there's definitely a benefit in terms of price when it comes to putting a deposit down. So it's not all bad. It's tough saving up for a deposit, but you definitely do get the benefits in price. And of course, that price is what you're going to pay over 20 years. So definitely do think about it like that. And this is, okay, I got ahead of myself. This is really what I want to show, is that, as your LTV goes higher, your interest rate goes higher. If you put a deposit down, your LTV goes down, then your interest rate also goes down. So just a little picture just to demonstrate that. So before going into this next picture, any questions or any thoughts, maybe what you wanted to chat about?
I don't have any questions. It's just it's really good information, and really great apps that I can use. I'm actually downloading the one app that you spoke about now. I think it's useful for me just to have all that information together so that I understand what I can afford and what I'm able to access, and the kind of properties to look at in terms of ballpark figures, when we start looking. So cool.
Are you? I think Tabaleng has left us for a minute. She might be back just now. Have you started? Are you actually looking for a property?
I am. I've been looking around.
What do you have in mind, Jared?
I'm obviously just looking 2 bedrooms, 2 parkings, 2 bathrooms. The 2 is always the great one to get. I'm still deciding if it's within Cape Town or if I'm going to look in Johannesburg. So I've just been looking around different areas, what the prices are like. It's a bit difficult in Cape Town because it's so expensive here. So chances are I might just make an investment up in Johannesburg. It's slightly more affordable. I'm still trying to understand what the market is sort of leaning towards. Is it student accommodation? And I need to just do more research on what rental is like at the moment in Johannesburg and Cape Town. So.
And buying for yourself as a home versus buying investment property, it's like totally different in terms of your decisioning criteria, right? And especially if it's in Joburg, the property almost needs to be low maintenance.
Correct.
Yeah.
So like face brick and all those things, and I would obviously have to fly up and see the property, but I would need to make sure that I don't need to sort of keep too close of an eye on it for too long.
Yeah. So if you maybe a couple thoughts. So from an affordability perspective, we spoke just now, 30,000 in gross income will allow you to lend around R1 million. Okay. Now the challenge here is that if you go and find a property in Joburg for say 750, you use 750 of your R1 million, you only have 250,000 Rand left over in terms of affordability. So it actually it uses it up. Now what you can do is the rent that you'd get for that property, you can add on to 30,000. So let's say, argument's sake, you get 8,000 Rand rent for 750,000 Rand an apartment in Joburg. So now your affordability is actually 38,000, and 30% of that, I'm kind of making these numbers up, is probably about 12,000, which means that actually your affordability increases now from R1 million to about R1.2 million, but you've used 750. So now you've got 450,000, so it increases, but it doesn't increase by the same amount that's been used up. Yeah. And it's worth just keeping that in mind, because although it's great, if you and your wife, want to settle down, want to have your own place, especially, in the next couple of years as maybe kids possibly comes onto the scene. I'm not sure if you've got kids or not. Then all of a sudden you're limited because actually your affordability is taken up by this property in Joburg. So it's worth doing these things, thinking, understanding how it impacts your next step. So I always say, if you don't want to buy your own home now, but you want to buy investment property, you want to do investment property now, home later, then be very clear about how it influences that later. You haven't got any regrets. I fully support your first home, your first property, if not your second property, both being investment properties, because at least it starts in that portfolio. That's something I would always suggest. But just having clear understanding of the impact it has on your ability to buy your own home later, and vice versa. Is that if you wanted to get into property investment, going and buying your dream starter home absolutely limits you in your ability to finance your property investment, your investment property, because usually with your first home, people tend to go and finance as much as they can, which actually which doesn't leave much room, because it's more of an emotional buy. It doesn't leave much room for that investment property. So people don't underestimate how much of an impact that has on the second decision they got to make. So without putting too much pressure, and it's great that you got the likes of Nigel and the team that he's brought together to actually think through these things, so that you understand the impacts, and then you make the decision, and the decision is always yours, but you have a better view of the impact it has.
Correct. So like I said to you, lots to think about still, and with each lecture that I get, with each person we get introduced to, or an authority person in the space, it changes your mind. You think you know what you want, and then you get more information, and then you reconfigure that. Today I'm reconfiguring again because now I've brought so many other things to the surface, and it's good because I think so many people fall into the trap of wanting to have a property portfolio, but they invest in the wrong way. And like you say, the one can't unlock the next one, it can't unlock the next one. And with fluctuating rates, if you don't take into consideration, you can actually shoot yourself in the foot and take yourself back to square one.
Yeah, absolutely. And there's no right or wrong decision. There's your decision. I think is the most frustrating thing, because you'd love there to be a right or wrong decision. No, great. So I just put this here, and actually there's a lot going on here, right? There's a lot going on here, and I just so one of the questions I get asked at the moment, like people think I know, is where are interest rates going to go? Now this goes back to 1998. Do you see 1998 interest rates? The red line was sitting at 25%. It hit as high as that, right? She said. I mean, I didn't have a bond at that time, but I just started working at the bank at that time, and I remember my parents stressing. Everyone was stressing, right? But it went up for a bit, and then it came right back down again, right? And then in 2002, that was the IT big bang, I guess. It went down to 13.5%, went right back up to 17%. That's significant. We saw an example just now, right, Jared, is that if interest rates are going to go back 2.5%, 2.2.5% back to 10%, well, what a difference that does on just a R1 million bond, So here we got 13 to 17, we got like 4% increase, 3.5% increase, right? So this really does put people under pressure. If interest rates do go back up, and I'd like to think that, I mean, these were massive shocks in the market, right? That 17%, that was the whole IT bang. That the next 15.5%, that was a financial crisis, right? And then it came back down, and it's been relatively stable since then until COVID hit. And then what they did with COVID is they just dropped the rates just to try and keep economies going, right? And then you got those three lines, and who knows where it will go, The economists I do speak to, who economists are funny people. They'll say on the one hand we think it will go here, on the right, and on the other hand we'll think it will go there. So they can never really give you a good outlook. But there's a general consensus that it will at least go back to 10% where it was before, just pre-COVID, possibly, but possibly a little bit higher to about 11%. But whether it goes in a nice straight orderly line, or whether it does the kind of things it did in 2002 and 2008, we'll have to see. But I guess for me, what I take out of this kind of graph, and I'm no economist by any means, is that as high as it goes, and there's blood on the streets, and the newspapers are screaming murder, it does come back. Things always come back to the center. Things always stabilize. And they might not stabilize where they were before, but they will stabilize. As you go into your first properties and financing, etc., first thing, keep some cash aside for if and when interest rates go crazy, or a geyser bursts, or for any kind of eventuality. Keep some cash aside, and then no matter what the stress is, things always normalize, whether it's interest rates or whether it's anything else pretty much in life. Things always do come back to the center. So I just wanted to share this with you, because I just think it's pertinent that last week we went up by 0.25%, right? Just to deal with that. Any questions on this picture? Nigel, does this scare you?
Not at all, actually. If anybody knows me and has been following my predictions over the last 3 to 5 years, every single interest prediction I've made came true. So this doesn't scare me at all. I always believed that after COVID, we were going to go back to the 10.5% level. And based on what you just said now, I continue to think that. I think in the next maybe year or so, we definitely will get back to the 10.5% level. If we get to 11%, I think it's a bit much. I think 10.5 will be the highest we'll go in the next year. Which basically over the last couple of months, I've always said to the students in the academy, if you're going to do a deal, make sure that the deal gives you a yield of 13.5% or higher. Because at 13.5% or higher, you are sure that even if we hit 10.5%, you still have a margin. So that's sort of always what I've been telling my students, and that's based on the deal as it is. If you look into the future and you say, okay, based on what I want to do, I'm going to reach 15 to 20%, you've got a massive margin. But at least on what the property currently is offering you, make it at least that you have a yield of about 13.5%. Doubling, you've got your hand up.
Yeah, I do. I wanted to just ask, so given that we see that the prime rate is going to go up, from my understanding, when you take a home loan, you can either do it on a variable or a fixed rate. Would you advise someone who's looking to buy now while the prime rate is still low? Would you say a fixed rate would be a good idea so that you never really?
Great question. And I actually wasn't going to cover it, so I'm so glad you raised it. So I really appreciate that. So you're absolutely right. So when you get quoted, so you submit your application to the bank, and they come back to you with a quote. You get quoted on what they call a variable rate, prime plus 0.5%, prime less 0.5%. Okay, it's all relative to prime, and what we're seeing in this graph is prime moving up and down. Fixed rate is effectively, you can get a 1 year up to a 5 year fixed rate, 1, 2, 3, 4, 5. All the banks have them. Some banks only have like a 1, 3, and 5, but all the banks have them. So once you've got your home loan application, once you've got your home loan registered, most banks won't be able to tell you what the fixed rate is before it's actually registered. Okay, and then only then do they say, okay, our fixed rate is this, because it changes. Some banks update their fixed rates once a week. So we update it once a month. And then they'll come back to you and say, okay, a 1 year fixed rate, and I haven't looked at my fixed rates for a bit, but a 1 year fixed rate will be, take today's rate and add 1%. So if you quoted prime plus 0, so prime, then your fixed rate for 1 year is going to be 8.25% fixed. Okay, whereas a rate fixed for 5 years might be a prime plus 2%. Okay, but that means that you immediately start paying prime plus 2. So what's it, 7.25 today plus 2%, 9.25%. You pay that now flat for the next 5 years. Now what we do is our guys go into the market and they find the funds to cover your home loan for those 5 years, and they transfer that cost to you. That's where that 2% comes from, right? So no matter what what happens with interest rates, you will pay that flat rate. Okay. So if you want to get out of it becomes a challenge. Say you want to sell your property, or you say, no, actually I want to go back to variable. The bank will charge you the interest that they've had to pay to secure that money. They'll charge you for it. ABSA doesn't make anything from it. It's a pure transfer. I think the other banks might be the same. So it just becomes very expensive if you change your mind. But it does give you certainty. I'd rather pay more, but I'm happy that I'm not going to be shocked by something that happens along the way. You don't want to live in that uncertainty. Going in now, where interest rates have already started increasing, those future prices are locked in, and you're probably not going to get the benefit of it. The time to fix maybe was 6 months ago, as an example. Okay. But it really comes down to, there are two strategies. Either take the increased rate for 1 to 5 years and you pay more, but it's certain. The certainty is worth more to you than the actual cost, increased cost. The second alternative is to actually see what that prime plus 2 might have cost you, and put that aside every month. Create a savings pool that should, if and when things do what you're concerned they might do, you have a savings pool to access to make those payments. Okay, and I mean, so the reason why you might go to fixed rates is because you're worried that in this picture, like in July 2005, was sitting at 10.5%. All of a sudden, went bang up to 15.5. Extra 5% in 18 months. That's heavy. You want to kind of you want to take that risk away. So you either create that savings for yourself, and if it doesn't happen, great, you got some savings that you can do something with. You can pay back into your home loan or whatever else. If it does happen, then you covered yourself. So if you're concerned about it, so human nature, we save and we spend. It takes a lot of discipline to save and not touch what starts to become a cup in a 5, 10, 20, 30,000 rand, right? Start dipping into that. If you're worried, if you don't think you can do that, then maybe go the fixed rate route. Does that cover the fixed rate question?
Yes, that covers my question.
Yeah,
Thank you.
yeah, but definitely something that's on the top of many people's minds at the moment, huh? So I've kind of gone the route of telling you what you can expect from a home loan. And I've put here, obviously an investor home loan of ABSA's buy to let. And although we're talking ABSA here, I'll tell you what specifically ABSA and what you'd get anywhere else. Okay, so that you get a sense for what the market can offer. Now, in Tabaleng, Jared and I were having a chat earlier on, and he's kind of doing and eyeing about, is his first home going to be a home, or is it going to be an investment? Okay, so but the reality is a home loan, the way it works, goes for both, and so it does apply. So with the ABSA buy to let and with a normal home loan, okay, it's essentially the same thing. You can get up to 100% loan to value. So you're looking at a property for about $1 million, and if your affordability is in place, if your credit score is good, there's no reason why you shouldn't be able to get 100% loan to value. Okay. Specifically for an investor, and this is more for investors who have existing rentals. We use 80% of that rental. And then for investors who have some portfolios, we have a thing called future rental income, which means you can add the income of the property that you're purchasing to your affordability. It's not necessarily where you guys are at the moment, but just to keep it in mind. But what's something important here is that you can get that 100% LTV. Okay. Your other challenge, maybe just to be prepared for it, is that being self-employed and not salaried, the salaried guys have it nice for them. As soon as you're self-employed, whether in your industries or you're on your own business, then you probably need to bank on probably a 90% LTV across the banks. So having to put down a 10% deposit. That isn't a rule, but rather bank on that and ask for 100. Always ask for what you want, and let the bank rather tell you what its offer is. And then you can negotiate from there. And then a further advance. So what a further advance is let's use an example of where you purchase the property for R1 million, and 5 years down the line, so you purchased the property in an area that was growing in value, and now this property is actually worth 1.2 million. It's increased in value by 200,000. And you've been paying your loan off. 5 years later, you're down to 800,000 on your home loan, as an example. So your outstanding loan is 800,000, but your property is now worth 1.2. You can come back to the bank and you can refinance and increase your loan to up to 1.2, so that you can actually access that 400,000 out of your own property. And that's what a further advance does. And that 400,000 you can use for any purpose that you want. It's yours. You know, if you've proven your affordability can handle a larger loan of 1.2, and the bank's happy with your repayment history and they're happy with the value of the property, then there's no reason why they won't give you up to that 400,000 as a further advance. So that's how you can start using property to create equity to use for other purposes. So if you're a property investor, what property investors typically do. And I'm gonna tell you the Burr strategy. So excuse me if this is very much property investor related, but I do believe that if you apply some property investment thinking in buying your first home, you're gonna make a better buy that's gonna help you in ways that you'll find out in the future. So what is the Burr strategy? It's a very, very common property investment strategy. It's the buy, renovate, rent, refinance, repeat strategy. So what property investors tend to do is they buy below market value. They're always looking for a good deal, okay? And that good deal might be because they found a seller who is in a rush to sell. Maybe talking about interest rates, maybe finding a seller who is very concerned about increasing interest rates or is in distress, and they're happy to sell at a lower price just to take their property off their shoulders. Or they find a property that isn't in great condition, but actually all it needs is a decent paint. Maybe the garden just needs to be fixed, and maybe the kitchen updated, for example. So they buy below market value. They then renovate, and in doing so, they paint the property out, the apartment or the house out. They fix the garden, do a little bit of landscaping, and maybe they update the kitchen, and they create value. In this example, they would then go, you can rent the property, but if you weren't going to rent and you're going to live in it, as example, so this works for either your own home or an investment. Then they go into the bank and they refinance, just as I said just now. So if I use a previous example, let's say they bought a property for 800,000, but the average in the area was 1 million. Of course, they got it 800,000 because the property wasn't in a great condition and the seller was in a rush to sell. Okay, they renovated the property and you take it back to the average value in the area of 1 million. You come back to the bank and you say, I want to refinance. So you bought at 800, refinance to 1 million. In principle, you could refinance and extract equity up to 200,000. So now your loan is 200,000. Sorry, your loan is 1 million. Excuse me, your loan is 1 million, but now you've got 200,000 in your pocket. Maybe less any costs you might have incurred with renovations, etc. But let's say in simple terms, you've got 200,000 in your pocket that you can now go use towards other things. If you're an investor, you might go use that 200,000 towards your next investment property. And that's where the repeat comes in. And this is how people build portfolios. They either use this strategy to flip homes, where they buy, renovate, and sell and get the profit out, and they keep the profit to buy the next home, or they buy, renovate, rent to get the rent, but they refinance, to the point where the rental can still handle the increased loan payments, and they use the equity to go find another rental property, and in that way build a portfolio. And of course, just this is where you use the bank, and in terms of further advances, up to 100% LTV, etc. It's a very, very common strategy for investors, whether they are flipping or whether they're building a portfolio, but also in terms of your own home. And this is where you apply some of the investor thinking towards your own personal home. If you can buy something that is below value, you can look at how you can extract equity potentially from that property towards a project or another or in a property investment, etc. I'm going to stop there for a second and just and apologies if we kind of seem to have gone very investorish in the presentation, but I think the principles do apply, and it's the property is a long-term investment, and whether you're buying for a home or whether you actively wanting to build an investor portfolio, having wearing a bit of an investor hat really does make a difference when you're wanting to utilize that asset for future uses. Any questions? Or maybe
yeah, I'm all good, thank you.
Yeah,
I'm fine. I don't have any questions.
Yeah,
just writing down and absorbing.
So Jared, we were chatting early on about either buying in Cape Town or buying in Joburg. What some people have done as their first homes is I'm going to tell you about my sister. She bought a place in Randburg in Johannesburg, and it had a terrible cottage on the property, but she bought it in such a way that the cottage has its own access. She doesn't have to live with her tenants. They have their own access, so it's almost like they are the neighbor, and we actually built a wall between them. But the reality is that her tenant, effectively, my sister doesn't pay utilities, doesn't pay water, lights, rates and taxes, because the rent that they get from the tenant covers that and part of the rent and part of the rent. So they talk about hustling with property, right?
Yeah.
So she did actually stretch herself a little bit, her and her husband, when they bought their property, but they bought it knowing that they could rent out a 1-bedroom apartment next door for 8,000 rand.
To make some extra money off of that to support their payments. Yeah.
And they've got a bigger property that might have been more bigger property than they would have been more comfortable with taking for themselves, but knowing that actually they're paying less than they would have paid otherwise. So, again, applying some of those, and now they become friends with the tenant, and when they go away, the tenant looks after their little dog and keeps an eye on the house.
Great deal,
so, yeah. So it actually works out quite nicely. So just kind of thinking about those things and maybe applying them. Yeah.
Gonna check that out as well, for sure.
Different options. Different ways of doing it, definitely, yeah.
I'm just learning as I go along. So
cool.
Thank you.
And then I think this is the last slide, and we're just kind of drop into conversation. As first-time buyers, the banks are very, very open and very, very keen to help first-time buyers, right? All the banks. We have 105% loan, and the additional 5% is actually there to cover transfer fees, which the buyer has to pay. But this is for what they call young professionals. If you have an NQF7, which I'm told is anything from a 3-year degree to a 4-year degree and something in between, and the equivalents, in terms of diplomas, etc. All the banks have something similar. I'm saying all. I think FNB, Standard Bank, I'm not sure about Nedbank, have something similar for first-time buyers. But even if you can't get the young professional 105, and I think Standard Bank is actually 110, the first-time banks are very keen, and they will give you definitely up to 100% for your first home loan. And then they do things like discounts with the attorneys. There's some cashbacks, etc. So every bank has their different offer, and we're just wanting to enable people to get onto the property ladder, etc. So definitely something to look out for and look at. But at the end of the day, if the bank's giving you 100%, no matter what the bank's giving you, what the bank thinks that you can afford, make sure that you're comfortable with what you can afford, because interest rates do go up. They sometimes come down. But one thing that always goes up is rates and taxes. You guys run your own businesses. the last thing you want is to be chasing a mortgage when you should be chasing something else. So you know, always I always say to investors and the like, you know, watch the numbers, make sure that you can comfortably manage, you know, something that should come your way. We all aspire to own our own properties, and you know, I think everyone, of course, should. But renting is probably, as a thumbsuck, you know, renting a 2-bedroom apartment or small house is probably about 2,000 to 4,000 rand cheaper than buying it for yourself. Just because as a tenant, you know, you don't have utilities to pay for, or rather the rates and taxes, often water's included. You don't have repairs to pay for, insurances, etc. You know, that's for the homeowner. So it's understanding those kind of somewhat hidden costs and little known costs that
slush fund has to be there.
Yeah, what's that?
The slush fund has to be there to do these extra things. Yeah, ish.
You've got to know what you're getting into, right? And
Yeah.
you know, as soon as you start building, buying your own home, and I mean, ultimately, once you've paid it off, you've got an asset effectively, right? And especially if you're building a portfolio, and if you build it correctly, you know, the right cash flows, as Nigel, you know, talks to, you know, it's something that can be built nicely over time, and it's something that can give you a lot of stability. You know, it's great to have multiple income streams. You know, and I guess, you know, you guys will definitely know about that. You know, but at the end of the day, it's got to be well thought out, because as much as it can support you, it can also bite you. Yeah. I'm going to pause there and see if there are any questions, or Nigel, any other aspects that are worth covering.
I think, I mean, based on all the stuff that you've said from a bond perspective, you've gone way over what I was expecting you to do, so which is fantastic.
Sure, those expectations are so low, hey?
Yeah. Yeah, no, the expectations aren't very high. No, I'm just joking. We specifically wanted you to focus on the bond aspect, but you did give a little bit more in terms of that whole rent to, you know, buy to let and all of those kinds of aspects, which is fantastic, because ultimately this whole exercise is not about buying a property to live in. It's actually, even if it is, it's more about the investment side. So the fact that you touched on that was fantastic.
Good.
Matt L, do you have any other questions? Because you sort of jumped in and out due to your issues with connectivity there. Jared asked I think all his questions. So Matt L, do you have any further questions? Sorry.
No, I don't have any other questions. I think the only other one was around is it the BRRRR?
The BRRRR strategy, yeah.
In terms of buying and then renovating, right? And then you get rental and then you refinance. What's normally like the timeline in that?
Sure, great question. You know, when we start looking at property investment and building portfolios, you know, we think we can be where, you know, Robert Kiyosaki, Rich Dad Poor Dad. We think we can like have this portfolio of 50 properties within a couple of years. I mean, that's possible, but 9 months. 9 months. So from OTP to having the cash back in your hand after refinance, you know, my experience is 9 months, and I'll break that down for you. You find a property, you finally, you know, you negotiate per the price, and you sign the OTP. That's month 1. It takes between there and actually getting registered is about 3 months. So applying for the finance, going through the registration is about 3 months. So then, you know, in month 3, now you get the property, and let's say there's a bit of a renovation that's required, right? But even that, the bank's not necessarily going to refinance you until it's seen you, you know, make a couple payments and then make sure it's comfortable with your payment behavior. So I would at least leave it for at least 3 to 4 months. So 3 plus 3 or 4, kind of in around month 7. And then you're going to come back and do a refinance. And a refinance requires a new application where they, you know, do a full assessment as if you're buying the property again. and that can take about 2 months for that cash to come out. So anything between 8 to 9 months. Some of the banks actually want to see you 6 months worth of payment behavior, which pushes you out to a year. So 9 months to a year, if to answer your question. The nice thing is that initially, as a first-time investor, first-time owner, the banks might require you to see a bit more payment, a bit longer payment behavior. But as you build a portfolio and the banks can see, you've got more to lose, you've got more sort of bigger sustainable income, etc. Then it can be quicker. But definitely at cycle time, my experience personally, 9 to 12 months. It takes a while. Property, if you're flipping, property can be a shorter term game, but then it's a higher risk because flipping is high risk. If you're building a portfolio, it's definitely a long game. It's something you do on the side, consistently focusing on the numbers and deliberately, and it's something you build up over time. I maybe wanted to talk to the portion where you sign OTPs and that portion over there around mortgage originators. Nigel, is it okay if I go there, or has that been? I don't want to conflict anything else.
No. I mean, it's always good to hear a different perspective. We will discuss the matter of mortgage originators in a different segment.
Okay.
But it's always, like I said, always good to get another perspective.
So I'll just touch on that, and it's really a comment around education. As you start looking around for property, and invariably, if you're starting to get to know some estate agents, so the way the process works is that usually you find a property, you're working with your local estate agent from Remax. Remax will deal with the seller. You get to a point where everyone signs the offer to purchase, and then Remax tells you, you know what, I've got a mortgage originator who I work with, and mortgage originators, what they do is they take your offer to purchase and they send it out to all the banks, and invariably, so it takes the admin away from going to 4 banks on your behalf, and invariably you get 4 banks coming back with their best offers, right? So it's a great way. It's very efficient, makes life easier, etc. So really mortgage originator is a great person to work with. First thing, you don't have to work with the estate agent's mortgage originator. If you have found another originator who you've come to know, or if with your bank, and you walk into the branch, you call the call center, and you say, who's my local home loans consultant, wherever your bank is, and they say, look, it's this person. Get to know them, or get to know a local mortgage originator. Uber, Better Bond, they are really great in education. Okay, and Nigel, I mean, you've got originators as well, right? They really find someone who'll be submitting your application, who is really great, kind of gets to know you and your structure, your business structure, etc. They should be giving you some advice as to how to best set you up for finance. Okay, so that when you have that offer to purchase signed, you can say to the estate agent, thank you very much. The estate agent will still get their commission from the deal, but you go to the originator or the home loans consultant who's given you their best advice, because they vested in you. They've invested some education in you. They know you, and they're best placed to possibly get you the best deal. Okay, and that's something. Don't get locked into. I had an issue this morning, and this is why maybe I was bringing up. I had an investor calling me, and she absolutely could not afford the property she was going for. Actually, has a property in Para. She could not afford the property at all. And I asked who the originator was. It's a company I never heard of, and they were just, kind of. You get some guys there who, what do they say? When you throw mud to the wall and see what sticks. she wasn't sticking, unfortunately, and she'd be given such bad advice. And I told her, actually, we've worked out on affordability, and she couldn't really afford what she was going for. But she hadn't been given that. All she knew is that all the banks were declining her because of affordability, and she didn't know why. She didn't know how to fix it. So get hold of someone from the bank, an originator, who can just give you some, have a 15, 20-minute conversation, understand what you can realistically afford and where you might face some challenges and how you can possibly address some of those challenges, get your financials up to date, etc. So that'd be a little piece of advice I think that would be helpful, and that's right up front. And it gives you a lot of confidence when you start looking for a property. It gives you a lot of confidence as to what you can and can't afford.
Yeah, some great advice, Miguel, because we obviously within the incubation, EDPF incubation and academy space, our biggest focus is to give the guys as much support as we possibly can. So within the framework, there is definitely the advice in terms of, can you actually afford this thing? If not, how can we make it work? If we can't make it work, walk away and try the next deal that actually will work for you. So the guidance and advice is definitely there within the incubation and academy space.
Nice.
But we do have obviously you guys to support us, and we have 1 or 2 specific originators that we work with. So it is great advice. And within the portal, within the platform, within the academy and the incubator, we do have that support for Jared and Matt Al, as well as for the students in the program.
Perfect. And it's amazing how much people, it's a privilege because there are many people out there who don't have advice, support, yeah. And then last comment, and then let's open up to a conversation. And Tabeling, I'd love to know, I'm going to ask in a second where you're looking at and what, kind of what do you have in mind as your first purchase. I was going to make a comment now. It's just gone right out of my head in terms of content and advice. It's gone right out of my head. But yeah. Oh yes. I spoke about finding a property that's in an area that's worth $1 million, but finding a property at lower value. You don't find those easily. But if you apply your mind and if you take time and you just focus on a broad area, it doesn't have to be too. I'm not saying like Cape Town. I'm saying if you focus on Simonstown, Jared, I know you're at Ntabaleng. If you focus on you in Sandown, if you're looking to purchase something along in one of the estates or complexes in Bryanston or Parkmore, if you just take your time and just keep watching and put those property alerts on, eventually it's amazing how those deals do pop up. And it's amazing how when you find the deal that works for you, either again as your home or as an investment, it's amazing how 2 weeks later you find the second deal. It tends to come in waves. But be consistent, take your time, don't rush into it, don't get frustrated. When you're getting frustrated, it means the deal's around the corner. Because invariably, I've been in a position where I was very frustrated. I wasn't finding something, so I took up an offer, the offer to purchase on something that I kind of ticked the boxes, but wasn't fantastic. And literally a week or 2 later, the fantastic deal came along, and I couldn't take advantage of it because I was already committed to something else. So take your time, know your numbers, use the support that Nigel and the team have to offer and I have to offer. And you will find it. There's the market's forever turning, forever churning. Let me pause there. And Tabeling, which areas are you looking at specifically? Anything in mind, or where might you be looking in the future if you're not looking currently?
I think for now, even though I'm based in Johannesburg, Sandown, I spent a good 10 years of my life in Pretoria. So I feel like I really understand, especially the student scene there. I went to the University of Pretoria, so I know the pressures of accommodation, not just in Hatfield, but just outside of it. So there's a lot of areas like there's Arcadia, there's Mukilnak, so I'm keeping my eye around there also, specifically because a university is something that will always be there. So I feel like yeah, there'll always be a need for student accommodation in that area.
Okay.
And yeah, something small, maybe like the other time we saw a really, really good deal when we were just randomly looking. Remember, Nigel? It was like a 3-bedroom or something, but it was a repossessed property. So I think that's why the price was so low. But I'm not looking to go above 500,000. Yeah.
Okay. Now, student accommodation is an interesting space. It can be very, very lucrative as well. Okay, no, excellent.
Guys, thank you very much, Miguel. That was absolutely amazing. I always find it quite boring to have these conversations myself, but that was an exciting discussion, and I'm sure that the public enjoyed it. I know that Jared and Matt Owl enjoyed the conversation based on the interactions that we've had. So thank you again very much, Miguel, for the time that you always have for us at the EDPF Academy. And thank you to the public. Thank you, Jared. Thank you, Matt L, for being part of this 50-day property challenge. And thank you to the public and the public at large in South Africa. And we hope to see you again tomorrow through this 50-day property challenge. Cheers, everybody, and enjoy the rest of your day.